what some of the pros were saying for 2011, this gentleman from Bank of America Merrill Lynch was broadly bullish on U.S. equities. BlackRock, which is a huge money manager as well, they were forecasting low double-digit returns, including dividends. And if we're wrong, they think they're too low. So they thought it was going to be a really good year for equities. And Dan Chung from Alger Funds thought stocks would rise more than 20%. It's always interesting to go back in hindsight, you know, it's just so clear. And Binky Chadha from Deutsche Bank thought it would, the S&P would rise 23%. Some people may have heard of John Paulson. He's a big hedge fund manager, and he gets quoted a lot in financial news and so forth. You can see what happened to him in 2011. He went from these huge profits in 2007, 2010 to a 51% loss last year. A lot of funds lost money last year. It was a really tough year for the markets because of all the fear. I mean, 2011 almost mirrored 2008, but from the European standpoint versus the U.S. standpoint in 2008 when things were falling apart. Meredith Whitney, she went on national television. This was the end of 2010, and she warned that there would be hundreds of billions of dollars in municipal bond defaults in 2011, and it just killed the municipal bond market. The prices went down, I mean, just wreaked havoc from one person. And the total, that's a lot of money, 1.68 billion, but it's nowhere near what she was predicting. And a lot of those were kind of known entities at the time that they were going to have problems. And Bill Gross, if anybody's ever heard of the PIMCO Total Return Fund, yeah, it's a huge bond fund. You know, it's the largest bond fund. And he bet heavily against U.S. Treasuries thinking there's no way the rates can go down further. And sure enough, they did. And, you know, he ended up giving a formal apology to his clients. And he lost a lot of sleep, I'm sure. There are a number of hedge fund managers that turned their keys in last year, essentially, because it was just such a difficult environment. And Warren Buffett, everybody knows who he is, right? Okay. So he made a $5 billion investment in Bank of America in August of 2011, and when it was around mid $5 range per share. And this was at the end of the year, and it's come back some since then, but he was down about $1 billion at the end of the year. So it happens. So the point is, forecasting is not easy at all. We try to do our best, you know, and there is something I heard someone explain one time. You can make a really good informed decision, but the outcome might not be what you're looking for. And you never know until it's over, and then you know afterwards. But so here's another forecast about 2008. It was expected to grow. It shrank. 2009, it was expected to shrink by 0.8%. It went down by 3.5%, our economy. And this is a quote from Mark Faber. When you make a prediction, never put a prediction time on it. So 2011, this is the performance that we pulled a few things out. So the Standard & Poor without dividends was flat, basically ended where it started. And that's a broad measure of companies. We don't have the small cap stocks in here, U.S. They were down for the year. The Dow was up somewhat, the Dow 30 stocks. The Dow Jones Global X U.S., so that means without U.S. in it, so just foreign, was down 16.7%. 10-year Treasury note, the yield on it was 1.9%. So you buy a bond last year and you're going to get a yield of 1.9% for 10 years. Yeah, I mean, that's how scared everybody was. Now, that is up over 2% now. That might not seem like much, but 2% is a real critical kind of number in this. Gold made 11.6% last year. That's from the first of the year to the end of the year. There was a lot of volatility in the middle, a lot of volatility. I think the day that the U.S. was downgraded, which was in August, I think the Dow lost 700 points that day, over 700 points. And the interesting thing is everybody was expecting it. You know, even some of the things we expect to happen, we don't know what the reaction is going to be. That is always this kind of unknown. The commodity index, that measures various types of metals and corn and wheat and things like that. That was down last year. Again, very volatile though. And then the REIT, which would be real estate investment trust. And that's actually what Cole Real Estate Investment Trust invests in. Commercial real estate was actually up last year. That's because it was so beaten down in 2008, 2009, and 2010. So long-term view. This chart is a little busy, but what it's showing is from the beginning of 2000 up until the end of 2011, what the best performing markets were. The top one, the brown, is India. Okay, that's the Sensex market. Then the blue under that, and that was 187.5%. But look at 2011. Okay, went down a lot. Then we have China is the blue. That was 56.4%. But again, went down a lot in 2011. The Hang Seng, which is Hong Kong, the green, that made 6.1%, but that was down a lot in 2011. And then we have the DAX, that's German, that lost 12.6% over that time period. The S&P 500 lost 13.6% over that time period. FTSE, that's the British stock market, that lost 16.4%. The French market lost 46.6%, and the Nikkei, which is Japanese, lost 55%. So, you know, this is the environment in which we've been in. The good news, it's not going to go on forever. Okay? There will be a time when things change. Don't even try to read the explanation for this. It's too complicated. What I wanted to point out is there are different kind of ratios of numbers that we look at. And if you notice, this is 1900 up through 2010 towards 2020. Okay, here are the 20s, 1920s. Okay, the bull market, long-term bull market started from this area, big negative in this ratio. Okay, then we have, you know, the crash, and then it came back up again in just 3 years, and then boom, down, 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 you know, over a decade. Then the next boom, next bull market started in the 50s, long term up to there, and then down, and then this is the last bull market. This is the one we all know of. This is from 1982 through beginning of 2000. But see where it starts? Okay? Now, we thought this was horrible. This is March of 2009. Okay? We remember 2008, 2009, everything going down. But it only went down to here. It didn't go down to where the bull markets typically start. So there's no saying that we're at the beginning of another big bull market right now. There aren't enough things in play, or not in play really, in position where you typically would have for the beginning of a long-term bull market increasing the value of stocks. It's just not there right now. Not yet. Doesn't mean short-term, you know, for months or, you know, a couple of years we won't have that. But long-term, decade, you know, over, that's not in play right now. At least from our past experience. So frequency of declines, we can see bear markets. Bear markets are 20% or more decline. Once every 6.3 years is the average. It doesn't mean they happen like that. It's just that's the average. Corrections, which are over 5% up to like 19%, excuse me, once every 3.1 years. And bear markets and corrections together happen every 2.1 years. So they're frequent. These things happen, and you know, if you get caught in those, you can really lose a lot of your money, and that's hard to climb your way back up again. The stock market, this shows, this was the high, October 9th, 2007. Okay, this was the highest close of the S&P, excuse me, in our past, you know, market where we are now. And we can see this was 2008 into 2009, a 56.8% loss. from the high. And then we can see it came back. You know, it was rough going, but it did come back. And this second high here, 101% return from here, was May 2nd of 2011. So after that point, we had some volatility, and then this is the summer. Last year, this was October 2nd, I believe it was. Not quite a bear market because it didn't go down 20%. And then we come back up, you know, and in January we've been coming back up. There's a key number we're looking for. I mean, we were out of the market we were out of emerging markets and foreign markets starting in May. Then we were out of the U.S. markets starting beginning of June. So we missed, you know, this. We also weren't here for this back up. We got back in here and then came back down. Now we're up above where we got in. And we got in at a lower number than we got out. So, you know, we're ahead in that respect. But we're looking for getting above this right now. We're almost there. We're within 7 points today. And it's important because these highs from these long periods of time act like this major resistance. You know, the market tries to get up to it and hits it and down, and if it can blow through it and go up, then that typically is a really good thing. So we're watching that right now. We're thinking it's going to go up above it. That's our thought right now. This chart shows various bear markets that we've had. This green one, this one right here, which is long term, that's the NASDAQ back in 2000. Remember when everybody was buying tech stocks and could make a ton of money and you didn't have to do anything in the 90s? That was so much fun. And then March of 2000 started the decline and the decline and decline. And all these years back, you know, it's still, you know, 60% less than where it was at that point. So that has never come back yet. The other one that's a big one is the gray. That's the Great Depression. Lasted a really long time, you know, 22 years. Then we have the Nikkei. That's the Japanese crash. And a lot of people are likening our situation to the Japanese situation where they're spending so much money, they're deep in debt, et cetera, et cetera. I tend to think that we're going to do better than the Japanese. I think we attract a lot more investment. We have a lot more going for us. And then the blue, that's the most recent, the one I just showed you from October of 2007 up through the end of 2011. And you can see there was a time where there was a lot of people thought we were going to be going into a long-term bear market, but it's come back. You know, it's kind of diverged from the trend there.